Hello, I'd like to take a moment to welcome everybody to today's webinar, Red or Blue, Elections, the Market, and You. Over the next 25 minutes or so, we'll be discussing historical elections along with some do's and don'ts for successfully navigating the upcoming election. We have a lot of great content. We hope that you'll enjoy today's session. Before we begin, I'd like to remind you that this webinar is educational in nature and is not to be construed as personalized investment advice. To kick things off, I'd like to give a brief introduction to Soltis Investment Advisors. Our mission statement is to create, build, and manage wealth so our clients are free to pursue life's most important endeavors. We're here as a resource to give you unbiased advice and support on your 401k plan. Please contact us with any questions you may have about saving, investing, or retirement, and we would be happy to assist you. We'd like to take just a minute to go over today's topics. We'll start out by talking about what the past has taught us about past elections of presidential candidates. We'll go over some details about this election. We'll cover the do's and don'ts during election cycles, and we'll give you some sound investment principles for all market conditions. To kick things off, let's go ahead and dive into what we've learned from past elections. A common theme you'll hear from friends, colleagues, and the news is that whoever wins the election will have a dramatic effect on the economy and the stock market. In fact, politicians themselves often make this very claim and use it as a part of their platform to get elected. Although this is a prevalent theme, the actual data does not support these claims. In fact, even when political parties change in the White House, the GDP, or gross domestic product, has continued to grow whether there was a Democrat or Republican replacing the outgoing president. This graphic does a great job at explaining how GDP has grown regardless of who is in the White House. So when someone claims that the economy or stock market will be largely affected if so-and-so wins or if so-and-so doesn't win, you can know that history has proven otherwise. The markets and economy are incredibly complex, but have been very resilient over time and tend to be much less dependent on political parties than many people think. You may be saying to yourself that this might make sense for the past, but this time is different. After all, we're in the middle of a global pandemic, high unemployment, and uncertain times. The pandemic has affected millions of people worldwide and has disrupted everyday life. It is understandable that many people might think that this time is different, but once again, time will prove that other factors are more at play than just who is in control of the government. These factors include the fundamentals of the economy, such as earnings, labor, and interest rates. In times such as these, it may seem that the stock market and the economy do not always behave in line with one another, so I recognize that this time may feel different. Yes, there are various issues that are on the table that could affect the economy, but the likelihood that the economy would implode because of them is pretty slim. As a case study, let's look at the 2008 global financial crisis. The chart on the screen helps illustrate that the overwhelming driver of the stock market collapse and subsequent recovery was the financial crisis and not the election. The market began to fall prior to the election and began to recover well before the next election. Note how many data points are on the chart, and only 3 of them, here in blue, red, and blue, are related to the election. And these are the nominations for the president as well as the presidential election where Obama won the 2008 election. The rest have to do with bailouts, the housing market, bankruptcies, and then starting to recover even with high unemployment rates. So these factors are really what drove it and not the election. So we've now established that the election in and of itself does not have significant bearing on the economy or returns from the stock market. The next logical question to ask is, how does the president's full term affect the stock market? As shown on the chart, the research shows an interesting story. There is no statistically significant difference in market returns between Republican or Democratic presidents. This may come as a surprise to you, but it's true. If you were to segment out the election versus non-election years, there's still less than a 1% difference between the two. This is probably much smaller than many people would profess to be the case, but this is good news. No matter who wins the presidency, it is likely that the economy and markets will keep moving forward as they have in the past. To further illustrate this point, let's look at this chart. The x-axis shows the months of a presidential term, and the y-axis shows the growth of a composite index. Each line represents a different makeup of the government, ranging from one-party sweeps to mixed compositions. We can see that the longer a president has been in office, the more likely returns are to increase as well. This holds true for all scenarios, including Republican and Democratic sweeps, as well as both mixed compositions of the government between Republicans and Democrats. Time has always been one of the biggest factors driving market returns, and the longer the time frame you look at, the more likely you are to see a positive return. This is why we recommend looking at your investments with an appropriate goals-based time frame instead of just looking at short-term market performance. Now that we've covered a few things in historical perspective, let's shed some light on the current election. This chart depicts each candidate's stance on a variety of issues. Please note that the bigger the difference there is between the issues, there is a smaller likelihood that the changes will be implemented. Such examples include taxes, regulation, and energy and the environment. This especially holds true if we have a divided Congress. Big changes are hard to come by and rarely get through Congress without compromise, so it's unlikely that we would see successful implementation of either party's campaign promises as they currently stand. Remember that neither party wants to disrupt the economy or markets in such a way that would jeopardize their ability to get reelected during the next election cycle. This should help comfort us if our preferred candidate does not win. Now that we have a better understanding of past and present election cycles, let's talk about how all this affects you in your portfolio. Let's start with some don'ts, and then we'll get into some positive action items that you can take. The first thing is don't panic. We understand that it can be easy to get caught up in all the excitement, but panicking certainly won't change anything or make anything better. In fact, it will only cause stress and uneasiness that could lead to actions that are counterproductive to your end goals. However, this does not mean that we're telling you to sit back and do nothing or to stick your head in the sand and totally ignore everything around you. Try and take a step back and talk to someone who can help put things into perspective. A Soltis advisor would be happy to talk to you if you're feeling nervous or panicked. We are here as a resource to help you get through these tough times through sound investment principles. The second thing you should not do is to try and time the market. By timing the market, we mean trying to speculate when the market will be as highs and lows and then selling and buying accordingly. The strategy rarely works, and studies have shown that investors who try and chase performance often buy into an investment after it's already outperformed and tend to sell their positions once they have experienced a loss. They effectively buy high and sell low, the exact opposite of what successful investors do. Please do not try and time the market around election day. The market is forward-looking, and it is a bad idea to center your investment strategy around the results of the election by simultaneously discounting all of the other factors that affect the markets that we've already talked about. To further illustrate this point, we can look at these calendars that have shown that oftentimes some of the best and worst market days occur within just a few days of each other. Just look at what happened in August 2015. The best and worst days of the year were just 2 days from each other, so trying to determine which days will be high and which days will be low is near impossible. This is why you can't afford to be out of the market on the sidelines waiting for the perfect time to get in, because no one will know when that will be. What would happen if you had stayed out of the market and missed some growth? Well, this chart shows the impact of being out of the market for some of the best days over the last 20 years ending in 2019. We can see that the best market days make up a large portion of the return of the overall market. This is important to keep in mind, especially since we know that the best days are often so close to the worst days. If you missed just the 10 best days, you would lose out on over 3.5% return. The message is clear. Timing the market consistently over the long term is very difficult and nearly impossible to do, so don't do it. With all the different election predictions going around you, you may be tempted to go all in on just one stock, based on the direction you think that things might be headed, either politically or economically. This is not a wise decision, and the amount of risk that one stock holds is quite more than the overall market. Your potential to lose value is much higher when your portfolio is concentrated in just one stock or even in just one sector. Going all in is essentially a loser's game that is not worth playing at the risk of losing your retirement savings. The next tip is to don't think that this time is an exception. I'll pause for just a few seconds so you can read some of the headlines at the bottom of the screen. Okay, so we'd like to think that all of the previous information we have covered is all good and well for times in the past, but that this time is different. We cling on to the belief that there's truly something that sets this time apart from all others. We have near zero interest rates, high unemployment, a pandemic, civil unrest, and a further widening of the political divide. Yes, we live in a unique period of time as far as the events surrounding us. However, that does not mean that these unique events will fundamentally change the drivers of the stock market or the economy. So just remember, when you hear that this time is different, you can know that while some of the details may be different, the fundamentals of the economy remain the same. This is not the time to throw out all of the conventional wisdom that tells us that things usually will turn out all right given enough time. This graphic helps illustrate this point with some of the biggest headlines during the last century. Warren Buffett phrased it so eloquently in 2008 when he stated, "In the 20th century, the United States endured 2 world wars, the Depression, a dozen or so recessions and financial panics, oil shocks, a flu epidemic, and the resignation of a disgraced president. Yet the Dow rose from 66 to 11,497 points. To give you some additional perspective, the Dow was around 28,367 points last time I checked around noon today. Each and every generation faces its shares of challenges, and our current challenges include the COVID-19 pandemic and a distressed political and social environment. We do not wish to diminish the current situation or convey a lack of empathy to the struggles that all of us are going through, but to simply acknowledge that the markets have historically been able to come back from even the most severe setbacks. If you're in need of someone to talk to, please contact us and we'll be happy to be a sounding board of reassurance. Our last note is to make changes to your portfolio based on others' opinions. We get much of our information from news headlines, friends, family, coworkers, and neighbors. This can be great when we're looking for a recommendation on a good mechanic, a place to eat out, or what is happening in your community. However, unless your source is a credentialed financial professional, it is best to steer away from their advice when it comes to your portfolio. Your situation, goals, and propensity for risk are all unique. This means that your investment plan should be catered around your goals and not just what you heard at the neighborhood barbecue or at the water cooler. Don't let a well thought out plan fall to the wayside just because someone else is doing something different. Please don't mistake passion and conviction for correctness either. As always, if it sounds too good to be true, it probably is. Now that we know what not to do, let's focus on things that we can and should do to get through these times. The first thing is to have a plan. Having a well-constructed financial plan can give you peace of mind while helping you prepare for the future. Have your plan focus on things you can control, such as how much money to save and invest, how much debt to eliminate, and how you plan on spending both now and in the future. Notice how the plan is focused on so much more than short-term events like elections, so keep that in mind as you build your plan. Planning is key to knowing where you are going and how you will get there. Without a plan, it is much easier to get overwhelmed and discouraged. The next tip is to stay the course. Your plan is a roadmap to help you get from the present to a desired future outcome, whether that be retirement, college education, or charitable giving. Oftentimes, you will experience things that will try and deter you from getting to your destination. However, you must stay the course even if storms are brewing on the horizon. Storms eventually give way to sunny skies and calm waters, and financial storms are no different. The markets have rebounded from every single depression and recession up until this point, The reason tells us that this will be the case going forward. By staying the course, you can weather the storm so that you can get to your desired destination. It may be hard, but it is the best course of action. It is important to note that staying the course does not mean doing absolutely nothing. Sometimes it means making minor adjustments, such as rebalancing your portfolio when your asset allocation has drifted from its target. Back in the financial shock during March, we encouraged our clients to rebalance their accounts back to their target by buying more equities, even though they had lost value. This was a hard thing to do emotionally for many people, but those who did it were rewarded by the subsequent rebound that occurred over the next several months. This is a great example of making a needed course correction to maintain the desired trajectory. The next step is to have a diversified portfolio. Having a diversified portfolio will help reduce the risk that if a single company does poorly, your whole portfolio will do poorly as well. It is very hard to tell which investments will be home runs, which ones will be average, and which ones will do poorly. That is why modern portfolio theory focuses on having several companies that do not move in line with each other in your portfolio. This will reduce the overall amount of risk in the portfolio and is essentially the idea of spreading your eggs across several baskets in case one gets dropped. There will be times when the market as a whole either rises or falls, but that's okay. We want to be focusing on reducing the risk that we can control and making sure that we are not concentrated in one company or sector. One way of achieving this is through mutual funds. Mutual funds invest in several to thousands of individual securities. Your 401k lineup is comprised of mutual funds, so you have built-in diversification. Soltis can help make sure that you are properly diversified within those mutual funds. Another tip is to continue to invest in the market under all conditions. Believe it or not, continuing to invest in the market as it's going down can be a good thing for the disciplined investor. This is because you get to buy shares of your investments at a lower price. The hope is that the price of these shares will rebound and be worth more in the future. You can almost think of it as buying things when they are on sale. You can buy a greater amount with each dollar when it's on sale than you could at full price. Let's go through an example to illustrate this point. The following illustration helps us understand why it's important to invest whether the market is going up or going down and how that can be beneficial. Investing in your 401k is a form of dollar cost averaging wherein you invest the same amount of each paycheck no matter what is happening with the market. In this scenario, investor A and investor B both invest $1,000 a month over 6 months. We can see here that this line represents the share price of the investment, and this represents each 1,000 investment at each month period. Please note that investor A and investor B invest in different mutual funds. Investor A's fund continually goes up, investors B goes down first before recovering. So if we were to look at this and guess which investor is going to end up with more money at the end of the day, who would you pick? Investor A or investor B? Well, let's find out. To start things off, investor A and investor B both buy 100 shares. The next month, the price for investor A's mutual fund rises, so they can only afford 91 shares. Investor B's price goes down, so they're able to buy more shares. Month three rolls around, and we have investor A price keeps going up, investor B's keeps going down. We look at investment period number 4, and investor A also keeps going up, investor B has gone flat. So at this point, if we look at investor A, their portfolio is worth $4,563 when they put $4,000 into it. Investor B's portfolio has lost money. It's only worth $3,354. But over the next 2 months, investor A's investment continues to rise, while investor B's does as well. So we get to the end, and investors A share price ends around $15 a share or so. Investor B's ends up right around 11 shares, $11 per share. So it only came back $1 more than when it started. If we're to look and see how much that comes out to, we just multiply the number of shares by the share price, and something very interesting happens. No surprise that investor A makes money, but when we look at investor B, they made even more money. Since they're able to accumulate 775 shares, that came out to $8,525 because even though the price went down here, it increased here, and that's where they made all of their money. So the moral of the story is investing when the market is down can be a great thing because you're getting more shares. The next thing you'll want to do is to have an appropriate asset allocation. One of the biggest things that you can do to be in control of your investments is to have an appropriate asset allocation that's based on your risk tolerance and your time horizon. When we talk about asset allocation, we're referring to your mixture of stocks and bonds in your portfolio. Real estate, cash, commodities, and alternatives can also fit into the asset allocation picture. You can further divide these broad categories into more specific sectors. We'll take a look at some of these sectors on the next slide in just a minute. Your asset allocation is going to be one of the biggest drivers of the volatility you'll experience, as well as the potential returns in your portfolio. Generally speaking, a portfolio with a greater allocation to stocks will have more volatility than a portfolio with a greater allocation to bonds. However, as a reward for taking on more risk, there tends to be higher long-term returns associated with stocks compared to bonds. A balanced portfolio for most people will have a mixture of both stocks and bonds. In their early years, most people will have a greater allocation towards stocks, and as they near retirement, they will start to incorporate more bonds into the portfolio. Now is a great time to review your asset allocation and check to see if it still matches your current time horizon and propensity towards risk. You'll want to balance your ability to sleep at night while at the same time be able to participate in the market growth for the future. This quilt chart shows several different asset classes represented by different colors. Does it look a little overwhelming? It should, as the whole point is to demonstrate there is no distinguishable pattern for which asset class will perform the best in any given year based on last year's past performance. Let's look at just two of these asset classes for the years 2017 and 2018. Emerging markets are shown in purple, and emerging markets are developing economies, and we have cash here in yellow, and we all know what cash is. If we look in 2017, emerging markets were the top performing asset class, and cash was the worst performing asset class. Well, if we fast forward just 1 year, cash is at the top at 2%, and emerging markets is down at the bottom at negative 14.3%. And then even if you wanted to go one more year, in 2019, cash was back at the bottom. So there's really no pattern to which asset class is going to do the best, and you cannot predict which one will be doing best next year based off of last year's performance. So it's very risky to go ahead and do so. So this really illustrates that we need to be diversified and we need to have exposure to all of the asset classes rather than just banking on one particular sector performing better than the others, because it might not, and that could be detrimental to your returns. So in summary, here are the don'ts. Don't panic, don't try and time the market, don't go all in on one stock position or sector, don't think this time is different, and don't change your portfolio based on news headlines or what you hear from friends, family, neighbors, coworkers, etc. So here are the do's. Have a plan, stay the course, have a diversified portfolio, continue to invest in the market, and have an appropriate asset allocation based on your goals, time horizon, and risk tolerance. If you do all these things, I think we'll be able to make it through this election cycle just fine. This concludes today's webinar. We really appreciate you coming out. And if you need to get in contact with us, you can email us on solsticeadvisors.com, or you can give us a call at 1-800-735-1601, and we look forward to serving you.